Hey everybody, and welcome to the second video from chapter 10. Now in this video I'm going to combine chapters 10.2 and 10.3 into collectively how banks manage risk. So we're going to go over the basic operations of a commercial bank, which really means that I'm just going to throw a bunch of definitions about metrics at you, and then we're going to talk about how banks manage different types of risk. So, if you remember that first equation, you should recognize as the balance sheet equation. And what's important with this is the equal sign. And for those of you that don't know anything about uh, accounting, that means that almost always all transactions are going to appear in at least two different accounts. And so a very simple example is right here. Let's say that somebody at Wells Fargo deposits $100. That means that they owe somebody $100 whenever they want. However, in the meantime, they also, as a bank, get $100 in cash. So that debt to the individual gets registered as a liability, but the cash on hand gets registered as an asset. And that's how you maintain the balance sheet equation. Also note with that, this means that shareholders' equity is not changed, so the fundamental value of the company doesn't change at all just when you deposit with them. Now, this is very simple, but the reality is usually a little bit more complicated than this. So let's really break it out even more. Let's say that somebody puts in, $100, and then they invest the cash on hand. So they put $60 into new loans. They put $30 into, securities. We'll say they invest in an MBS or something, and then they keep $10 in reserves. Then that means we're registering three different kinds of assets that collectively equal $100 to balance out the liability side. Now, let's say that they receive some cash in terms through the interest that they get from the loan that they give out. Let's say that they add an extra $10 down here. Well, that's not a liability, right? They don't owe anybody that $10. And so what we would do is see assets, and then it would get registered in shareholders' equity with the plus $10. Clean that up for you. And so shareholders' equity is going to go up $10. And so the net value of the company of Wells Fargo in this case is going to go up by $10 because they used those $100 in deposits to generate $10 in interest. So that's how a bank generates value, and that's how they record that net worth change. Now let's get into those definitions that I promised you. First, the bank's spread is the return on assets minus the interest paid on deposits. Because remember, savings accounts, any sort of time deposits like CDs or anything, you have to pay some interest. And the return on assets, if you remember, is the interest that the bank is going to receive on the investment, such as if they make, a new loan or if they invest like in an MBS or something. The bank spread is basically their net operating return. So if their ROI on their assets is 8% and they have to pay 2% interest on their time deposits, but 0% on anything else, then the bank spread is 6%. Next definition is the return on assets. And the return on assets, let's just not overthink this here. This just means if you're looking for the return on anything, you want to take a look at your profit over all the assets that you have. So if you have $1 billion in assets and you make, you know, $1 million in profit per year, then your ROA is 0.1%. So pretty small, but we're dealing with small interest rates here. Now, the return on equity is a little bit different. So what we're going to do is, this looks a little bit complicated, but you can look at it a different way. If you plug in this formula here, then bank assets is going to cancel out from the top and the bottom. And so you're looking at just the after-tax profit over the capital on hand that a bank has. And so what this does is it eliminates assets like, for example, if they have a branch building, then that building is considered an asset, but it really doesn't do anything in terms of capital. They're not trading the building on capital. And so that's why bank assets then can sometimes be significantly higher than the after-tax profit because, if it's a very expensive location, then their assets are going to be inflated tremendously. So ROE is actually usually a little bit more important when we're looking at the profitability of a bank. Other than that, it's calculated the exact same way. Now, you've probably heard leverage referred to quite a bit. And leverage is just a measure of how much debt an investor assumes when making an investment. And so the leverage that a bank has on aggregate is the ratio of the assets versus the capital that they have. And if it's greater than 1, then that means that they've done at least some debt financing. If it's less than 1, that means that they just, have cash on hand and can make their next investment on cash. Uh, if it gets too high, though, that leverage, then they become what we call over levered. So we're talking about like they're just issuing debt left and right, left and right, left and right. Then they become over levered, and so because of that, the government has mandated capital requirements to prevent banks from doing so. So they have to have some sort of ratio between the value of capital and the bank's total assets, which they can willingly change in order to increase economic productivity. Now let's look at different types of risk. And the first we're going to talk about is liquidity risk. So liquidity risk is just the possibility that a bank may not meet its cash needs by selling its short-term liquid assets or raising funds. And this can either happen from either a drop of the asset's value or just by not holding enough liquid assets. So for example, if an asset's extremely liquid, but then it comes to term, it's no longer a liquid asset, and so that becomes potentially problematic. And the biggest way that liquidity risk is mitigated is through the repo market, as I mentioned. When a bank is worried that they're going to have problems because their assets have dropped in value too much, and so they have to dip into their illiquid assets, they'll enter into the repo market, get this loan, and then unwind their illiquid assets to a point where they have enough liquidity and then sell the asset back through the repo market. Additionally, in extenuating circumstances, the Fed will give what are called discount loans, which just means that the Fed will willingly lend to banks at a reasonable interest rate. Now let's look at credit risk. And credit risk should be a little bit more familiar. This is just the risk that borrowers might default on their loans. And the main way to prevent this is just through diversification. And that's just the best way to do so. And if you remember from our discussion on swaps, this is what an interest swap is it allows for diversification, and as with a credit swap. Additionally, uh, when you can enter into a credit swap, what a bank will try and do is diversify who it lends to. If it's lending to too many companies in one sector, it may stop so that it can keep some sort of diversified portfolio. And in rare instances, especially in times of recessions, they'll just stop issuing debt easily, or they'll increase the credit requirements before lending. And the way that they decide what to do with all three of these is through credit risk analysis, which is just how officers screen their loan applicants. And we're going to talk about this in a supplemental video, but whenever you want to take out a loan, It's through the credit risk analysis that is why your credit score is so important to maintain. Now, in rare instances, we get what's called credit rationing. And it's actually, I shouldn't say rare, it's rare that it becomes an existential problem to the economy. And that just usually comes out of recession. But credit rationing is just the restriction of credit by lenders that results in borrowers not being able to obtain all the funds that they desire. So there's either supply side or demand side issues. So first, rationing can actually be a solution to the moral hazard problem because it increases the probability of repayment. That's why 18-year-old college students don't get credit card limits with $10,000 on it, is because of the moral hazard problem that, a bank could extort the student, get them enticed, make them rack up massive credit card debt and never repay it, but they always impose some sort of limit on what they can do in order to make sure that there's going to be repayment. The same thing is done with mortgages. Mortgage sizes will vary based on the credit score of the applicant to avoid the moral hazard problem. Now, also on the flip side, denying loans entirely can increase a bank's profit, especially when they have problems discerning the quality of an applicant. And this is especially problematic during times of recession when credit and default risk is very fluid. So banks have a lot of problems discerning what's a good or bad investment, if we're looking at like corporations, for example. Uh, and so they may just deny the loans to prevent that that problem in trying to sift through the quality of the applicant. Now, the final type of risk that commercial banks have is interest rate risk, which is just the risk that a change in market interest rates has on a bank's profit or capital. And this is especially important to look at when looking at a bank's balance sheet, because on the balance sheet, they'll always break up their interest assets into fixed rate and flexible interest rate income. And the fixed rates are a lot safer for a bank because they know what they're going to get. The only risk that they have associated with a fixed rate is default risk. However, with flexible rates, they expose themselves to interest rate risk. Additionally, and this is a little bit of a more obtuse topic, so let me know if it confuses you. There is what we have to do, which is called duration analysis, which looks at how sensitive a bank's capital is to changes in market interest rates. And it's important to look specifically at a bank's duration gap, which is called the average duration of assets minus the duration of liabilities. Now, typically a bank has a duration gap of greater than zero. And why is that? Well, it's just because a lot of the assets that they have are long-term assets. If you think about a mortgage, we're talking like the length of like 20 or 30 years. If we're talking about student loans, we're talking about decades. Even like cars, we're talking about, 5 or 10 years. However, on their liabilities, in case you didn't notice, a lot of these liabilities that we're referring to have pretty short lifespans. On top of it, with like a checking account, a lot of people will cycle through their credit in the checking account fairly quickly. Like, if you just go into your checking account, go and take a look, try and graph all the different plots and the points, and you'll get like a large spike whenever you get, your check for your wages. And then after that, it goes down rapidly until you get your next paycheck. And so, it's almost always greater than zero for a bank. And if it gets too big, then we have significant interest rate risk, because that means is that increasing market interest rates are going to decrease the value of your assets more than the liabilities and decrease the value of capital that a bank has. Again, it's a weird topic, but let's look at it a different way. Uh, let's say that collectively interest rates rise in the economy. That's good, right? For a bank, that means that they can charge more on a mortgage or loan that they issue. However, as I mentioned, these take so long to come into duration that the bank can't just suddenly start issuing mortgages and new loans left and right. They have to wait for the new corporation or whatever to come to them. However, they're still operating in, the repo market with deposits, etc., which have a very fast turnover. And as the interest rates continue to go up, they have to pay more and more each time they take on a new liability. And so that on the net means that while they're waiting for this 30-year mortgage to expire and come to term so that they can use the money on a new mortgage, they just keep having to pay more and more interest every single time they take on new debt. And so that's why looking at a bank duration gap is really important in understanding what the interest rate risk is that a bank has. With that, you let me know. Like I said, I understand that this is kind of weird to think about. It's a different context because you're looking at rates of change in different types in different spots on the balance sheet. So let me know if you have any questions. But other than that, we're now ready to go to the last video from the chapter.